Welcome back to this week's market update. Today is Monday, August 25th, 2025, and we will jump right in. Taking a quick look at last week's market performance, stocks slipped earlier in the week but rebounded sharply on Friday, as you can see here, as the Federal Reserve signaled greater openness to rate cuts, easing investor concerns about the slowing U.S. economy. By the close on August 22nd, the Dow Jones Industrial Average was up more than 1.5%, the S&P 500 up just shy of 0.3%, and then the Nasdaq Composite down about 0.6% last week, as the drag from the earlier week sell-off was not able to be offset by Friday's rally. Moving into our economic news from last week, stocks rallied on Friday after Fed Chair Jerome Powell delivered a very dovish speech at the annual Jackson Hole Economic Symposium. The event has become increasingly influential in recent years, shaping a lot of investor expectations around monetary policy. The remarks this year were very much in stark contrast to his 2022 comments over some pain that he said might have been required as the Fed was raising rates at that time to fight inflation, which at that time also triggered a pretty broad market sell-off for several months as investors were preparing for tighter monetary policy. On Friday last week, though, Powell emphasized that with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting their policy stance, presumably to a more accommodative stance for monetary policy. So markets basically took that as a pretty clear sign that the Fed is ready to cut rates soon, and that led to quite a few changes in interest rate expectations based off of futures pricing here. You can see that the probability of rates staying the same in September moved from about 25% to just over 10% as of Friday last week. And then the chances that we get at least one 25 basis point rate cut rose from about 75% to about 90%. So some pretty stark changes in expectations following this economic symposium, leading to the market's rally on Friday last week. Also last week, we got the leading economic index from the Conference Board showing that leading indicators declined 0.1% for this index in the month of July, and they are down about 2.7% over the last 6 months. So that is an increased rate of decline for these leading indicators, but they have been negative for quite some time, so we have to take that with a bit of a grain of salt just because we do see a lot of indicators like weekly initial claims. This was a positive contributor, as well as a stock market rally, the leading credit index, some pretty strong indicators here within the data, even though the overall index is weak. Some bright spots, especially the stock market, because that tends to be a forward-looking indicator. On the other hand, though, leading indicators like consumer expectations, new orders, and building permits were on the negative side of the LEI here. So overall, leading indicators continue to be pretty bearish, but we do see some bright spots, especially like the stock market, credit conditions, and the job market pretty stable as well. Looking at some recent major retailers' earnings that came out last week, TJX, Target, and Walmart all had some pretty differing results based on current analyst expectations, as well as how they're handling the current increases in tariffs. So starting off with TJX companies, including TJ Maxx, Marshalls, Home Goods, all of those sorts of stores, they beat expectations, raised their guidance, and they also highlighted how they are dealing with the tariffs. So because most of their product sourcing can be done domestically, they take different merchandises from retailers that are already imported into the US. They are having a very limited impact from the tariffs as of right now, which has led them to see these stronger financial results. So you can see they're up just shy of 13% year to date, more than the market, up about 10%, so strong performance for TJX. Target, however, they did beat expectations for the quarter, but they continue to have a pretty weak outlook, with sales actually projected to decline over the coming year. They also announced a CEO change, partially due to some political headwinds that the company is facing, as well as just their weak financial performance, putting some pressure on management. You can see the stock is down 26% year to date. And then last but not least, kind of in the middle of the pack between these two, Walmart beat expectations. They raised their guidance. They're also seeing pretty strong comparable sales growth, especially in Sam's Club, and how they're dealing with the tariffs while they're passing on tariff costs to consumers in some categories and absorbing in others. So being a little bit more strategic in how they choose to pass on tariffs or absorb the costs into their margins. You can see Walmart is up about 7% year to date. Last but not least, the White House announced a 10% stake in chipmaker Intel, valued at roughly $8.9 billion last week. The investment will be funded partly through CHIPS Act grants and partly through allocations for secure chipmaking programs domestically. This comes at a time where Intel has been lagging its peers, both internationally with some pretty tough competition, as well as some technological setbacks and weaker financial results. However, this move was taken as a positive thing, as shown by the stock price. You can see it is up more than 25% this month, up 5% on Friday when the White House announced this definitive agreement. It also underscores a broader shift in U.S. industrial policy, with the government taking a more active role in corporate America. So that concludes this week's market update. We thank you so much for tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.